If you bought a house in the last handful of years, or maybe you've owned it for quite some time, we've had a lot of people reaching out to us about should they use the equity in the house to pay off debt. Now, if you took out your mortgage in the last 6 years to 3 years ago, so during the COVID years, this may not be as applicable to you, but if you have credit cards you can't get ahead of, you have a home equity line of credit, you're not feeling comfortable about that variable rate on, then this video is for you to talk through when to think about refinancing and what options might exist that you may not be thinking about regarding this debt. First, what comes to my mind is kind of like a bucket, right? Because if you have your house, if you have credit cards, let's say you have an auto loan or student loans, whatever it is, if you go with the guise of, say, a Susie Orman, she's going to say it's all just your debt by putting into a bucket. It is your debt. What does that mean? Does that mean you should tap into your home equity? It's not to say so. It kind of depends on what's going on and how much are you talking about. First, I'm going to share my screen real quick, and I'm going to talk to you about kind of what I had seen here around a report from Experian on the average amount of what's called a home equity loan in that they're seeing taken out these days. So actually what you see here is it's actually somewhere between $45,000 and $50,000 in the last few years of what people are taking out in equity on their home. And a lot of these people easily say they probably didn't touch that first mortgage, but if they're feeling uncomfortable about that variable second mortgage, a lot of people use what's called a home equity line of credit, then they may be thinking about other alternatives. You can see by state, as an example here in Colorado, it's kind of right in line with that, or just under $50,000. What I found was interesting here is South Dakota, almost $75,000, the average home equity line of credit in the state of South Dakota. With that to be said, what are some ways that this can make sense for you to do? One thing you want to pay attention to right now is interest rates, because if these trade agreements continue to happen, if inflation continues to come down, and that's a big if right now because nobody knows if that will continue. So don't plan for it, hope for the best. But in a case that we had for this client, what we ended up determining was that they were going to stay in the house. So first and foremost, a very important thing to understand, because if you have a lot of equity and you have consumer debt, but you're going to sell in the next few years, I might just wait it out and pay it off when I sell my house. But in this case, no plans to go anywhere. So it all became about cash flow, paying off a home equity line of credit that they had and additional credit cards, and getting about $20,000 of additional cash. Now, after this was all said and done, they were still going to have about $200,000 of equity remaining in the home after the fact, but they're going to relinquish thousands of dollars a month of consumer debt, put it all into a new first mortgage that will increase their personal cash flow. The interesting thing is that I don't think it's touched on about this is it's going to alleviate the stress. What is the stress? Well, if you paid off 7 or 8 bills, that's 7 or 8 pieces of information you no longer have to think about. Maybe you have auto payments on them, but you might have the physical cards in your presence. I don't know, but getting rid of that mental baggage out of your backpack. So in that case, additional benefit for them. Not to say that everybody should take out equity in their house, but it is something to think about. Break-even analysis. Okay, so I have a video about closing costs that I did do. Break-even analysis. This is something I think is great, except I think a lot of people miss an important thing, and that is you're going to skip a payment. If you close today and the payment isn't to the first of the following month, so let's say you close in June, your payment is in August. July, you would have normally sent a mortgage payment. On the refinance, you will skip that. It will stay in your checking account. What do you do with the money? And about 45 days after closing, if your taxes and insurance are in your mortgage payment, they're going to be sent back to you in what's called an escrow refund. What do you do with those two aspects of what I call found money? Because if you have total closing costs, you're saying, I'm going to save X per month, and the closing costs are Y, so it's going to take this many months to break even for this refinance to make sense. I'm going to say, did you deduct the escrow refund? Did you deduct the skipped payment? Because if those apply to you and you didn't deduct them from the closing cost, you're not looking at a true break even on the cost of your refinance. So don't forget that one, because that one to me is important, because you will find that money when it's sitting in your checking account and you get an escrow refund from your current servicer. A couple alternatives: if you have an FHA or a VA loan, and let's say you have a decent rate by today's standard, let's say you had a 6.5, you actually could refinance without even taking equity out of your home right now and get a cheaper payment by what's called an adjustable rate mortgage. Check out my other video. Actually, I did on ARMs. It's specific to VA loans, but it can apply to FHA loans to get an education and background on what those are and if they're applicable or beneficial to you. Now, to understand what that means to you, a home equity line of credit, and I do have a video on my channel about that. I think it's about 5 minutes long, but it can educate you on what a home equity line of credit is and how it can help you. One of the pure benefits of the home equity line of credit is you can choose to pay interest only. Now, before you call me batshit crazy for saying pay interest only, look, if you're disciplined, if you save money and you don't hold consumer debt longer term, but you get bonuses, commissions, things of this nature, you can lop off those home equity line of credit balances like a credit card. And just like a credit card, the month following that minimum payment goes down, so you have more control over your personal cash flow management. Now, to think about some other things regarding this, as far as interest rates go, if you have an FHA or VA, especially with a VA, that is genuine money that you could take, remodel your house, pay off debt. You can go to Vegas, not advisable, but these are the things you can do with that. Home values, we are seeing them to be relatively flat. As an example, here in Denver, they're not falling through the earth and cratering, much to the chagrin of some of the click bros here on YouTube. I ain't about to say that things are going up in value, but look, it's still considered a slight seller's market. So home prices aren't necessarily going down. It's more about recalibration of home values and sellers recognizing that as a buyer, y'all have a little bit more control right now. So some things that you want to think about regarding pitfalls, regarding the thought to refinance. You know, there is the you will reset your terms. Look, if you're going to sell in the next few years, you're not paying off the house. The person buying the house is paying it off, so it may not be applicable. But if you can improve your cash flow dramatically every month, and that credit card has been just part of your personal budget for years, let's be honest, you're not paying it off on your own. So maybe doing a cash out refinance makes sense to you. You don't have to do a 30. You could do a 28, a 26, 22-year fixed. You can do an adjustable rate. That FHA and VA adjustable rate, 5-year adjustable rate mortgage is something to really think about if you're looking at refinancing a government loan. Time when it makes sense to refinance. So things to think about regarding taking out the equity from your house. As to what will it accomplish for you, seek payment savings. Things to look at here, if you're thinking against it, is if you have those credit cards, I'm just going to simply ask you, how long has it been in your monthly budget, those payments? If it's just recent because of a recent occurrence and you've done that before and paid it off and you're disciplined, this may not apply to you. But if it's been part of your budget, as long as you can remember, call it what it is. It's part of your monthly expense. You may have the intention to pay off the credit card. It just may not happen because of life or other things. So the most important thing is, if you do tap into that equity, make sure to think about taking out, if you don't have an emergency fund, taking out 6 to 12 months of emergency funds, putting it into maybe a high yield savings online. And the reason for that is you should be able to get rid of some of those credit cards, maybe keep a couple of them. Don't keep them in your wallet. And with that money that you pull out for the emergency fund, don't keep it in your checking. Don't keep it in your savings. Transfer it to an online bank where it might take you 3 days to get it back. Because once you do that, it'll be there, and we can agree it will give you peace of mind. So having that money aside, if you don't have an emergency fund and you go through the process of doing a cash out refi or pulling a home equity line of credit, maybe pull some extra. Think about it. If that were $20,000 in this example, that might cost you, $100 a month. So if you can afford that in your budget, and it gives you the ability to have that peace of mind because you got the 6 to 12 months of emergency funds you don't currently have, you're not going to be reliant on those credit cards. Just don't buy the stuff you don't need. So a little bit of insight about things to think about in refinancing today. Check out additional videos, like I said, on the VA adjustable rate mortgage. It also applies to FHA loans. And from there, if you want a consultation, calendly.com/mortgage maestro. If you like educational information on your wealth in real estate, subscribe to the channel. Thanks so much. We'll talk to you soon.